Welcome back to the Retire As You Desire show. And in our last segment, I showed people how your Social Security is taxed. I showed you the thresholds, whether you're filing single, married, filing jointly, or if you're a head of household. All of these things are going to play a huge role in retirement. Now, in the last scenario, $130,000 of adjusted gross income. That's your AGI. Your accountant could potentially help you figure out all these numbers for your own scenario. We're just using simple numbers for easy comparisons in today's show. So I want to describe now what it looks like to have up to 50% of your benefits that are taxed if combined income is between $25,000 and $34,000 for single filers, or $32,000 and $44,000 for a married filing jointly couple. Up to 85% of those Social Security benefits are taxable if combined income exceeds $34,000 or $44,000, depending if you're single filing or married filing jointly. But if your combined income, if you're married, which is $130,000, 85% of your Social Security benefits will be taxable. 85%. It's huge. So let's take things even deeper right now. Let's calculate what the taxable amount is going to look like for you, depending on your federal tax return. So 85% of your Social Security benefits is going to look like 0.85 multiplied by your $60,000 of Social Security benefits. 85% of $60,000. That means that your taxable amount is going to look like $51,000. You're probably thinking, what? I didn't know about this. That's why you're watching the Retire As You Desire show. But therefore, $51,000 of your Social Security benefits will be included in your taxable income. It's a huge amount, huge amount. So the final taxable income calculation is all about your taxable income is going to equal your AGI plus the taxable portion of your Social Security benefits is going to really create that taxable income. It's very important to know this. So going back to your AGI, which was $100,000, if you add $51,000 of the taxable portion of your Social Security, that relates to $151,000 now, because we're over these taxable thresholds of taxable income. So you're going to be taxed on $151,000, not the $130,000, unfortunately. So you're going to have a higher tax bill because of this. This is why it's so important to plan to try and avoid this before you go into retirement and understand where your dollars are going, whether they're going to be taxed later in retirement or if you pay your tax bill up front. I prefer paying the tax bill up front, as you can see why. Now, here are some things that we really need to take into consideration as well. We work with clients in multiple different states throughout the United States, and some states have different taxes on your Social Security benefits, but the rules vary widely. You're going to want to check your state's tax guidelines to determine if your benefits are taxable in that state. And that's another thing to really understand is, where are you going to retire? If you want to retire in a tax-friendly state, it may cost you more money to buy a home. So there's a lot of different variances that are going to go into these big time decisions. Now, you're going to receive a form called SSA 1099. Each year you receive a benefit from the Social Security Administration, you're going to receive this SSA 1099. And this shows you the total benefits that you received during that calendar year. You're going to use this form to help determine the taxable portion of your benefits with the IRS and your accountant or your financial advisor. Now, the IRS does have worksheets to help provide some instructions. So if you're a do-it-yourselfer investor and you're here watching this show for great information, you could do a 1040 SR. That could help you calculate the taxation of your Social Security benefits for the future, for that year. Now, from a taxation standpoint, your benefits are going to depend on a lot of different scenarios. Where your money is coming from an income standpoint, how much you're receiving from a Social Security standpoint, and you have non-taxable income. All these things play a huge role for your retirement, and it's going to play a big role from a taxation standpoint. And being a financial advisor, it's really coming down to how much money are you keeping from your investable dollars. That's part of the game in retirement. Albert Einstein said, it's all about knowing how to play the game in the best way possible, and understanding the nuances of Social Security taxation is a big deal in retirement planning. So if you're thinking, how in the world am I supposed to receive income in retirement from my investments? Here are some tax saving strategies to help you along the way for your retirement years. Number one, this is something that we do with our clients pretty consistently, is analyze whether you should do what's called a Roth IRA conversion. Now, I want to be very clear. You want to know where you're at from a tax bracket standpoint. How close are you to jumping into a next tax bracket if you're going to do a Roth IRA conversion in retirement? But there is a caveat to this, a huge one. If you jump into a next tax bracket, let's say you go from the 22 to the 24% tax bracket, this is not going to make your whole entire dollar amount taxable at that higher tax bracket. Let's say you only go $1 over into the 24% tax bracket. That $1 is going to be taxed 24 cents on the dollar, just that $1. There's separate brackets, and once you hit different levels, whether it's a 10, 12, 22, 24, etc., tax bracket, the dollar amounts that you're inside of that bracket get taxed at that bracket. It's called a marginal appreciation. So you don't need to be afraid going into a next tax bracket. I think that's a big misnomer for retirement income planning. I hear this a lot. I've heard this with new clients coming on board. Our accountant said, don't go into a new tax bracket. Our old advisor said, don't do this or don't do that. We need to understand that if you go into a new tax bracket, it's not the end of the world, because if we're hitting those numbers anyways, your Social Security is probably, I'm saying probably, at an 85% taxation rate at those levels, especially if you're at the 24, 32, and those higher tax brackets. So from a planning perspective, we want to look at doing Roth IRA conversions and understanding what's the break-even point? How many years do I need to invest this money after I pay my tax bill to get to this break-even point? This is very important. We can calculate this for you, but also municipal bonds, if you've been a high earner, which a lot of our clients are, and if they're using them, this can still create taxation on your Social Security, even though it's going to basically be tax-free income for you, but it's included in the Social Security aspect from a correlation taxation standpoint. It's confusing. It's super confusing. This is why you want to work with a professional. Now, income from life insurance, if you set up a life insurance policy that has tax appreciation, that has some cash value built inside of it, if you take money out, which may or may not be in your best interest, you have to work with your advisor on this, but this could help not make your Social Security taxable. So this is a tax strategy that some people have used, but again, you're buying life insurance for life insurance or estate planning standpoints. But this tool could be used to help mitigate some taxes in retirement. If you want to borrow money against the cash value, but you have to look at the benefits. There's never a perfect scenario with this, but this could help try and mitigate some taxation in retirement. And the one thing that does not make your Social Security taxable is income from Roth IRAs or Roth 401ks. The reason for this, you've already paid your tax bill, and this is what I'm in favor of. This is what we help our clients with. Pay your tax bill now, so that way, when you want to withdraw money in retirement, you could potentially keep more of your Social Security income. You could potentially not jump into a new tax bracket. You could potentially not make your Medicare premiums more expensive as well, because there's 4 different tax brackets from that standpoint as well, something that we're going to discuss on another show, that makes your Social Security and your Medicare premiums taxable. So there's more money coming out of your pocket. At the end of the day, this money is yours, and it's really wise to plan to keep the money in your pocket, and that's what we are here to do at the Retire As You Desire Lifestyle Company. Just want to help you get your money in great places to help you have a great retirement and hopefully not pay as much taxes in retirement. Stay tuned. Gonna have a great wrap up for the segment here. Stay tuned to the Retire As You Desire show. So withdrawing from a Roth IRA account. Now, traditionally speaking, when you withdraw from a Roth IRA account, it's tax-free as long as you follow the rules, and there are certain rules, but this could help reduce your combined income. Another thing to do is manage other income sources. You want to be mindful of other income that may increase your AGI.